Good afternoon and welcome to the latest edition of Office Hours. I am Joe Perfetti. I am the host of the show, and today we have a very special edition of Office Hours that will focus on the concept of spread, one of the core concepts associated with value creation in finance. So I'd like to explain that topic more in depth, and so I'll give you an understanding of what I mean by spread. And then I'll give you some practical application tips and tools to think about this on the job and as leaders of an organization. So let me just basically say that as we get started, this concept is very important because 50% of the spread of any business is determined by the industry that it is in. But let me talk about spread as a concept because I think that gets in the way of people's understanding. This is kind of very important to finance. So I'll start out with a simple definition and ask a question. If you had the opportunity to borrow money at 6% and invest that money to make 4%, would you do it? Right? And I think it's hopefully a rhetorical question because the answer should obviously be not, because if you're borrowing at 6 and you're making 4, can't pay back the 6. And believe it or not, this is probably the most fundamental thing that you need to know about corporate finance, right? And this is the concept of spread. And it's very intuitive to common sense, but what gets complicated in the business world is the language that we use. So today I want to explore that language in a little bit more depth. So when I say that you're borrowing at 6%, in the corporate world, we call that a hurdle rate, right? Because that's the rate that you have to hurdle in order to pay the money back. And ultimately, the hurdle rate is an interest rate, an annualized basis, and it's adjusted for risk. So the idea is, from a financial perspective, this is the rate of return that I'm going to give you the money. And if you can't hurdle it, then you're not going to meet my expectations. Because at the end of the day, creating value is about exceeding expectations. And the hurdle rate defines the expectations for a company. Now, externally, we call the hurdle rate the cost of capital, or cost of money, where capital's cash. And it's often called a WACC, or a weighted average cost of capital, because we borrow from multiple sources. We borrow from banks, we borrow from bondholders, we borrow from shareholders, and the weighted average of what pays them back is essentially the WACC. So, and just for fun, we can flip the terms. We can call the external rate the hurdle rate, we can call the internal rate the cost of capital. But the idea is it's the expectation of the return. And ultimately, people in finance, leaders of our corporation, understand what that rate is. I'm going to show you what that rate is for companies in the real world using a tool called Bloomberg in just a second. But basically, when I put the money to work, that's the 4%. And the 4% is what we make on our projects or our products. Now, internally, that average rate of return is called an IRR, an internal rate of return. The average rate of return over the life of a project or cycle of a product is called the IRR. Now, we end up all of our projects and products, we get the company. At the company level, we call it the return on the invested capital, the ROIC, or return on capital employed for Europeans that may be on this call. But the idea is internal rate of return project, ROIC company, but just for fun, we can flip those. We can say, what's the internal rate of return of the company, ROIC of the project? It's just job security on the financial function. Language gets in the way. And in a very basic concept, over the life of a product, over the cycle of a company, we have to have a return greater than people's expectation, the risk, the hurdle rate, in order to create value. And 50% of this spread, the difference between the two, is based on the industry that you're in. And if you think about it, the role of a CEO is really simple. They're just a broker. They borrow from the market, and the market says, make this amount of money and the money I give you. They turn it around, they lend it internally, and the leaders of the company have to beat that rate. And if they can't do it, company can't create value. There's no magic behind this. So let's put this, as I said, into practice and do some practical application here. So I'm going to share my screen and bring up a tool called Bloomberg, or Bloomberg Professional, or some people will call it the Bloomberg. And basically, what Bloomberg is Michael Bloomberg's company. He is the former mayor of New York. It's the reason he's a billionaire. But this is the pro tool that you would use if you were on Wall Street. And so if you worked at Goldman Sachs or Morgan Stanley or Deutsche Bank, this is the tool that's actually on your desk. So right now, the screen I happen to be on is called Daybreak, and it gives kind of investors a quick view of what you need to know, cliff notes for the market. And it's basically telling them today, with all the coronavirus increases in hospitalizations, we need to be worried about it. Jobless claims are higher than expected, yada, yada. But what I want to do is I want to pick a random company, okay? So, for example, we're talking about the virus, COVID-19. Pfizer's been in the news. So let's see how Pfizer is doing. So I'm going to look up Pfizer. And this is a real-time stock quote. But what I do want to do is I want to see Pfizer's industry. And so Bloomberg allows investors to get a real-time view of the industry using something called RV, or relative valuation. And so Bloomberg is one of the few tools that will basically allow you to do real-time pure analysis. Now, this is a default list, analyst-picked list of Pfizer's big global pharmaceutical peers. And again, there's a lot of data points they have in here that I can look at that are the predefined templates. But I'm going to go over here to custom. And this allows me to look up any data point on any company that I want. So the data I'm going to look at as a column is what is the ROIC, return on invested capital, for these companies. And it'll ask me which one do I want. And so I'm going to pick the last time period of the latest filing. And I'm going to hit enter. And this top row says market cap weighted average. And what Bloomberg is one of the few tools in the world that can give you real-time industry averages adjusted for size. So some tiny company doesn't distort the average of anything you want to look at. So this is the industry average of these peers. And this column over here says ROIC, return on invested capital, as of the latest filing. So last 12 months. So it's either based on the second quarter or third quarter, depending on reporting results. We're reporting seasons right now of 2020 on an annualized basis of these companies. So here's how to interpret this data. So for the pharmaceutical industry, if I gave them $1, they made 18.34 cents of cash profit per dollar of investment in the last 12 months, right? If I invested in Pfizer, I gave them $1. They made 9.3 cents of cash profit. If I invested in Merck, they made 18.3. If I invested in Bristol Myers, you broke even. At Lilly, made 22. Novo Nordisk, 69.8%. A lot of money in diabetes. But basically, you can get a sense of the industry. And then I'm going to add a second column called the weighted average cost of capital, which is what is the borrowing cost for these companies today? And this gets me my spread. So this industry today is borrowing at 6% per year. So again, that's a risk-adjusted hurdle rate. And the idea is that if I believe that you take on more risk, I charge you more money. And this is the rate that you're charged on an annualized basis. So this industry is borrowing at 6. You invest and you make 18. Now, very simply, and this should seem obvious, this is an attractive industry. Right? I like this industry because I'm making a great rate of return relative to the amount that I'm borrowing. That's exactly the way investors look. Now, Pfizer, believe it or not, is actually underperforming its peers. It's creating value. It's borrowing at 5.4, a little bit less than the industry. It's only making 9 in an industry that's making 18. That's how I start to look at competitors. And for the most part, with the exception of Bayer, who seems to be really struggling and losing money, everyone in this industry is making money, and most firms are doing reasonably well. And that's the point of the industry, because half your performance is the industry. If you're in a good industry, it's easier to make money. So I'm going to just pick a couple of different companies. If anybody's watching this and wants me to look up anybody in particular, feel free to type it in the chat, and I'm happy to look up whoever you want. Let's pull a couple of different companies just to see how we're doing. So I've saved this as a template, my spread template here. And what I'm going to do is I'm just going to replace it with a different company. So instead of pharmaceuticals, let's look at, I don't know, automobiles. So here's Ford. We'll see how the automobile industry is doing. So I'm going to get rid of some of the other data here so you don't have to worry about seeing it. So in the automobile industry, you can see the average company right now is losing money on this list. This is Global Auto. They're losing basically 0.25 cents per dollar of investment right now, and they're borrowing at 9. So this is what we would call a bad industry. Okay, you're borrowing at 9, 8.84. You're investing, and you're losing 0.25%. Okay, Ford is borrowing at 2. They're not as risky, and they're losing 2. But either way, it's pretty awful. And pretty much no one in this industry, with the exception of Ferrari, is doing well. So again, if you sell $250,000 cars in this market, you're doing okay. But everybody else can't escape that COVID-19 has devastated the automobile industry. And that's what you can see. So how have other companies done? Well, let's look at, I don't know, airlines. It's pretty depressing. Here's United Airlines. Travel. It really sucks to be an airline right now. Okay. The average airline is losing 12.5 cents per dollar. If you wonder why this industry is hanging on by a thread, this is why. And again, if your volume drops by 70%, there's nothing you can do. It doesn't matter who you are, right? And that's one of the problems the industry's facing, but it's one of the lessons that I wanted us to understand. Because I can tell you all day long that the academic studies tell you that half your performance is the industry that you're in. It's much easier to see this in practice. That's why when we deal with leaders, we tell them, look, think about the markets that you're going in. It doesn't matter how well you execute if you're going into a poor market, right? And flipping it around, even if you execute mediocre and you go into a great market, it can be very forgiving. But if you're in the airline industry and you go in, it doesn't matter how good you are. You could be Southwest. You could be one of the best run airlines, still not going to make money. That's just a very important leadership lesson as we think about how we tie this back into strategy versus looking at, say, a Walmart. We can see that these companies, what's called discount retail, actually been doing pretty well in our COVID-based world, which again, regardless of what's going on with the virus, people need to go out, eat, shop. And this industry is actually doing well. They're borrowing at 5, making 13. Walmart's borrowing at 5, 4.5, making 11. Costco's doing really well, borrowing at 6, making 16. We can look at different segments. So for example, if I wanted to look at grocery stores, here's like Safeway or Kroger. Ticker. Do Kroger. Onto the Bloomberg interface, you type the wrong thing in, it sends you off on a wild goose chase. So back to regularly scheduled programming. So looking at grocery store industry, not as attractive as discount retail, but again, a little lower risk, borrowing at 3.4, making 8. And that's the other thing I just wanted to subtly show you is back here on the concept of risk. You'll notice that the risk is relatively plus or minus about 1% similar across the industry. So if I'm investing in grocery stores, it's a relatively low risk industry, and therefore investors are not charging me as much. Versus when I invest in, say, defense and aerospace, like here's Lockheed Martin, this industry is perceived to be higher risk. And so they're borrowing at 7.4%. So again, there's an industry level of risk, an industry level of uncertainty that also plays out as we go through this. Some people were asking about a couple of different things. So let's look up GILD. I don't know who they are, but let me look them up. GILD. Oh, Gilead. There we go. So here's Gilead. Again, biotech. That's the way to think about this. A second. So biotech peers. So this is a big list of biotechs. And again, I'll look at the spreads. So again, biotech industry, not doing as well as the pharma, but again, a lot of these companies might be earlier stage, but the industry is borrowing at 6, making about 9. Gilead borrowing at 4, making 3. They're not doing that well. Vertex seems to be doing really well, borrowing at 6.5, making 34. Some other early stage biotechs. Again, this you see a little bit more of a variance just because of the different nature of the industry. And again, some of the lower performing companies also have higher risks associated with them. Who else do we have in the chat? Somebody wanted to look at Tesla and then retail or apparel. This, by the way, is why my students actually love playing around with a Bloomberg tool. They actually do this all semester long, and then they think they can be professional investors very quickly. But let's look at, I don't know, PVH as an example. So this is the brand owner for Calvin Klein, Tommy Hilfiger. So we can see that the apparel companies are really struggling right now. The average apparel company is losing money, negative 1% return. PVH is really struggling. They're down to a negative 8% return. Underwear, Hanes Brand's doing relatively well, but a lot of the brand companies are struggling. And again, risk levels a little bit higher than you saw in the grocery store industry. Average company in this industry is borrowing at about 8%. PVH a little less risky, but really struggling. Again, Ralph Lauren losing money as well. So again, look at a different industry versus if I go to, say, a Macy's, and I can just work my way through the chain. This is part of the problem because these branded retailers are selling to these department stores. The department stores are losing money too. Matter of fact, Macy's is losing almost 30 cents per dollar. I don't know how much longer they're going to be able to hang on because they were even struggling before we even got the recessionary period. But this is, again, an awful industry for retail. Somebody asked about Tesla. But the other thing that we're doing here is this is what I like to call scorekeeping. This is accounting, okay? And what we're doing is we are looking backwards, right? What did we do last month, last quarter, last year? This is last 12 months, ROIC. And don't get me wrong, as investors, we like to keep score. It's no different than in any sports thing that we do. You know, did our team win? How many games did they play? How many games in a row did they win? What was the score of the game? That's no different than what we're doing here. And by the way, ROIC is a proxy for cash. So when we keep score, it actually helps us understand how to price the companies that we're looking at historically. So let me give you an example. I'm going to go back to the pharmaceutical industry. So here is a company called Merck. Okay? And Merck is a pharmaceutical company with actually one of the best-selling drugs in the world called Keytruda, which is really a miracle cure for immunotherapy for cancer. But one of the things I want to talk about is Merck stock price. Now, they're actually doing reasonably well this year, but let's look at them over time. And I'll do FA, and I'll look at historical data. And for historical data, I'm going to go to custom again, look up whatever data that I want. And the data points I'm going to look at are spread. So what is my ROIC, return on invested capital, there it is, year by year for the last 6 years. And what is my WACC year by year for the last 6 years? That's just backwards looking as opposed to today. And for those of you watching, I want you to look at this. And I want you to think of ROIC like cash flow. So if you make a 4.64% ROIC in 2014, it means you're generating 4.6 cents in cash. That's cash. So ROIC is just a proxy for cash flow. So if you generate a 17-cent ROIC, you're generating 17 cents for cash per dollar. You did 7, etc. So look at how much cash they're generating and look at the cost of capital is kind of the cash they're expected to generate per period. So I want you to look at the spread, and the only other thing that matters here is growth. How fast are you growing that ROIC, growing the cash flow? So Merck has been flat growth, so I'll just leave that in here for the time being. Actually, instead of telling you that, let me show you this. Revenue growth year over year. It hasn't had huge amounts of growth, shrunk 4, 6, flat, 5, and now they're starting to grow again. But the point is, I want you to look at the spread and picture what their share price would look like. So if ROIC equals cash and spread is the expectation, tell me what you think the share price might look like over time. Okay. And here it's kind of probably flat, maybe a little declining. And then it probably starts to get higher and then surge. Like that's what the data should tell you if you're looking at this. So the question is, does the real world work in the same way? So what I'm going to do is I'm going to come over here and I'm going to graph Merck share price. And I'm going to go back to November 2013. So we'll basically cover that 6-year period through today. This is 6 years of data. So here's a graph. We just looked at that data. We said relatively flat, maybe a little dip in here. In the last 2 years, it's improved. It's gotten better. So what's happening, and again, it might be easier to kind of overlay this. We're going to just edit the chart. Oh, here's edit chart. I'm going to add the ROIC to this chart so it's easier to see. But basically, the white line is the share price. The blue line is the quarter by quarter ROIC that they're reporting. And you see a pretty good correlation over time. And so basically, when they're making 4 or 5% ROIC, share price is here. When they're making 10%, gets here. When they're making 17%, it's up here. And so it should seem obvious to you because it is. I mean, again, we go through, I spent 14 weeks. I'm a graduate of the Wharton School of Business at the University of Pennsylvania, supposedly one of the top finance programs in the world. And the first semester finance course is 14 weeks on spread. And if you don't understand that at the end of that course, they don't let you pass. And if you want to become a finance major at Wharton, you take 3 more semesters of spread. And then at the end of that, then you go work on Wall Street. And so it's just so indoctrinated to you that this is how we intuitively make decisions. This is how intuitively we price the business. This is what we look for. And so as I said, it should be blindingly obvious because it's a basic, simple concept. We just make it sound complicated because there's a lot of numbers and a lot of language in there, but the concept itself is pretty straightforward. And this is exactly how we keep score at a very high level. And everything eventually will work its way out, but this is at a high level what we do. Okay. So one last thing I just want to mention, a very short webinar. And again, if you have any questions, feel free to ask, is I'm now going to go in search of spread. So instead of looking backwards, let me also put my manager hat on and say, okay, what companies are actually doing well? What companies are not doing well? Now I know how to measure people. So I'm going to go over here and I'm going to look at equity screening tool. So what Bloomberg allows you to do is pretty much for 1.4 million securities out there in the real world, search for them and screen for them in any criteria that you want. So the criteria I'm going to say is show me stocks in the S&P 500, of which there are 505 companies in the S&P 500 index, which I've always found interesting because there's actually some dual listed stocks. So for example, when I work with Google, better known as Alphabet, they actually have Class A shares and Class C shares. So there are actually 2 stocks in the S&P 500, even though there's 500 companies, but 500 companies in this list, some dual listed. So it's 500 companies. These are US companies. And then what I'm going to do is I'm going to say, okay, how many of them have an ROIC greater than 20%? So based on the last reported results, 69 of them are exceeding 20% in the last 12 months. And then ROIC is cash flow. And then the question is how fast are growing that ROIC? So if I make 20% and I grow at 5% a year, that's not as valuable as if I make 20% and I grow at 10% a year. So growth accelerates. It's growth cash flow. That leads to the total value. So then I'm going to add in growth. So I'll look at revenue growth. Spell growth right. That's the hardest part of the tool, is typing. All right. And I'm going to look at year-over-year revenue growth. And instead of doing it on a quarter basis, again, it's based on the latest year. So 12-month year. And again, I want greater than 20% as well. So show me the 2020 companies. The percentage of companies that have 20% ROIC and are growing their sales 20% a year. These companies should be doing pretty well. There's 6 of them, by the way, in the S&P 500 that meet that criteria. Let's see who they are. All right, these are the 6 companies. Align Tech, Vertex, Adobe, Paycom, KLA, and Facebook. Here's what's interesting. This is their ROICs. This is their growth rates. Very high ROICs, very growth. But over here, year-to-date return. With the exception of Vertex, you made 59% in Align Tech. You made 39% in Adobe. You made 44% on Paycom, 37% on Facebook, KLA, and 33% on Facebook. All right. So generally, if you invest in this group, you average a 35% rate of return. So that's the point. ROIC at 20%, grow 20%. This is the cash they generate. You own that cash. You do pretty well. So this is what the institutions look for. And this is how we start thinking about placing our bets in the marketplace. Now, the only thing about Vertex is, why is this a busted stock? What's wrong here given their performance? Well, that's where we get to the definition of finance. See, here's how finance starts to differ from accounting. Accounting is about the past. I told you, we're scorekeeping here, right? And what I like to say is, you can't drive a car, look in the rearview mirror. So the other side of this conversation is not what did you do in the past, but what are you going to do in the future? Because that's what matters. So it's not your ROIC in the past as much as what your ROIC in the future is going to be. Tell me about your future spread. That is more important to value because you're worth the sum of your future cash flow. So expectations play a key role. Okay. And that's going to be the source of another conversation that we'll do at a different office hours. But I will at least give you a little of a sneak peek into this to try to understand what's going on here. So, by the way, if we were to take a company and I happen to be on Merck, this is where we get into what the analysts do. And so there's a group of people on Wall Street called the sell side analysts. These are the people that actually do the buy, sell, hold recommendations on your stock. Okay. And they're very important. As a matter of fact, for Merck, there's 24 of them. And they're the people that work for the banks. So it's Mara Goldstein of Mizuho. It's Louise Chen of Cantor Fitzgerald. It's David Reisinger of Morgan Stanley, blah, blah, blah. I could scroll down the list. Now, what these people do is they write a buy, sell, hold opinion, okay, and create a target stock price. So right now, for Merck, it's real-time data. 19 of these analysts rate Merck a buy. Buys are worth 5 points. 5 of them rate them as hold. Holds are worth 3 points. None say sell. So on a 5-point basis, Merck is a 4.58 out of 5. So they're pretty high on Merck in terms of its future. Now, these are 12-month share price targets. They're all predicting what the share price is going to be in 12 months. The average share price target is 95.89. It's wisdom of the crowd. That's the average of this list. Today, Merck is at 79.64. So basically what they're saying is 20% upside in the next 12 months. Now, what's interesting is 20% upside sounds a lot like Merck's 19% ROIC, but coincidence. And the last 12 months, Merck is down 3.1. So again, that's just kind of a view of the future. But the more important view of the future is these spreadsheets. Because what these analysts are doing is they're all putting forecasts of what they think the company is going to do, forecasting the financials. And they're uploading them to Bloomberg. And they're giving us this. This is a real-time view into what's called the consensus estimate database. This is the expectation for what Merck is expected to do for the next 4 years. So this year, $46.8 billion in sales in 2019. 2020, they should get $48 billion in sales. 2021, $51.5 billion, and $54 billion, and $55 billion, and profit. So I know the sales, I know the profit, I know what they're spending for CapEx. This is the forecast for cash flow. This is return on investment in the future. This matters more than the past because I bet on the future. And by the way, they're getting pretty granular because, for example, if I look at Merck, Merck is the sum of its drugs. So here's the forecast for Merck's drug by drug for the next 4 years. And so Keytruda is a good example. This year, Keytruda is $14 billion worth of sales. By 2023, it'll be $20.6 billion worth of sales, just that one drug, and it'll be the largest selling drug in the world. And by the way, this scrolls all the way down to the pipeline. So these are the drugs that are still in early clinical trials that haven't launched yet, including Virus 114. This actually might be their COVID drug. But the point of the story is, I don't know the code names. I had to go back and look them up. But that's the other side, is we're not just looking at what you're selling now. We're trying to make a forecast of what you're going to do in the future when we look at the business. And it's no different than if this were Amazon. If you want to see why Amazon is such a monster here, this is the forecast for sales and profits. All right, Amazon. For Amazon for the next 4 years. This is all organic growth, by the way. Last year, they were $280 billion in sales. By 2023, they're expected to be $606 billion worth of sales without acquisitions. So, just as an example, when Amazon this week launches their online pharmacy, it drove a lot more sales to the business and obviously took them away from some of the other players. But nonetheless, you can see why people are so excited about Amazon's future. So it's not just about how you're doing today. Someone was asking about Tesla. It's also how you're expected to do tomorrow. And Tesla's about to be added to that S&P 500 because this year they're at 24 billion in sales. By 2023, they're expected to be $60 billion worth of sales. And so everybody's like, well, Tesla, they haven't really done much. It's not what they've done, it's what they're expected to do. And that's just a little hint and teaser about what we're going to cover in a future office hours. But we're reaching the end of our time today. And so today it was really about spread. Okay. So ultimately, it's about understanding what is your spread. It's about thinking through the expectations, but it's always asking the question that value creation is about risk and reward. And so I'll kind of end where I began and say, if you don't know what the expectations are, how do you know if you're creating value? So ultimately, you need to know what those expectations are. So you need to ask what the hurdle rate is. It is always a fair question to ask the hurdle rate. And if finance ever goes back to you and tells you, why do you want to know? I mean, the answer is that you're not trying to get competitive information. It's you want to know what the expectations are, because it's no different than what the market is doing to the company. We are doing to the people inside. And we have to know what those expectations are, because that's eventually how we're going to be judged. If you'd like to know more about any of this, feel free to reach me at learningcommunities.com. Also, just a quick plug here, because I got to pay some bills. If you go to our website, I actually do a course on all of this material through Duke. It's called Building Financial Acumen. You're welcome to sign up for that or reach out for any information about this. Again, hopefully you'll see you at a future edition of Office Hours. Thanks for watching today. Goodbye, everybody. Have a great day.